Hey, everybody. We are going to wait here for about a minute before we get started to allow some folks to trickle in. I see it about, I don't know, about 20% of you that signed up already joined. So thank you to those who have joined on time. We appreciate you. While we wait for not too much longer, there is going to be a Q&A session at the end. And so we'll address any questions that you guys have at the end of that, or at the end of the presentation in the open Q&A. So get those questions ready. We definitely want to answer any questions that you guys have about this new product that we're offering, which is a 90% loan to cost ground up construction. We're really excited about it. So we'll give it just a few more minutes here, or not even a few more minutes, just a few more seconds before we get started. All right. We'll go ahead and get started. Anybody else that trickles in, you can definitely stick around afterwards. Again, there's a Q&A. We'll answer any questions that you might have that didn't get answered during the presentation. And we look forward to speaking with anybody that has any questions. So we'll go ahead and get started. This webinar is essentially designed to introduce a new product that Central Lending is offering: 90% loan to cost ground up construction. We were typically offering up to 85%, but that is changing. And so a couple of things to start with. My name is Isaac. I'm the director of Originations. I kind of help the sales team here review all of the scenarios, take a look at things we can and cannot do, pitch them to our credit desk, and ultimately get loans approved. What we consider a ground up construction deal at Central Lending is going to be essentially what we'll discuss today. The fact that we're now offering 90% loan to cost, a couple of case studies, who qualifies for those loans, what kind of credit and experience adjustments we have on any ground up construction loan, and then why you would want to send us the loan here at Central Lending. So we'll go ahead and get started. So just a little bit about me. I've done 9 figures in loans in the last probably 3-4 years. I understand kind of the ins and outs of the types of loans that private credit offers, not just private credit in the sense of institutional private credit, but private credit in the sense of, country club money, as I like to call it. These are loans that we balance sheet from funds that we have raised over the last, I think, 7 years that Central Lending has been around. So we've got various funds that we pull credit from and that we fund loans on. But ultimately, to get this highest leverage, the 90% loan to cost, we are talking mainly about institutional capital. So essentially for ground up construction, what we talk about is buying a piece of land, either already entitled or getting it entitled, developing from pre-development to plans, permits, zoning changes, anything that's required. 1 to 10 units is kind of our wheelhouse. And we really want to focus on new construction only. We don't want to really focus on mid-construction, although we do it. We like having full control of the development cycle from start to finish, and that simply just helps us deliver a better product across the board. These are going to be 6 to 18-month loans. Most of them are landing between 12 and 18 months, unless it's like a modular build or a mobile home, which we do fund both. But most of them are going to be 12 to 18 months from start to finish, and that just allows time for entitlements, any zoning changes that need to happen, and then, of course, ultimately construction and certificate of occupancy. We are very similar to most other lenders in that we release draws during the build process based on completed work. So you're not pre-funded any draws. There's nothing that is extended prior to work being completed. Your borrower or your clients have to have working capital in order to get the project started, and then they can take as many or as few draws as they'd like. Obviously, the fewer they take, the bigger they are, the lower draw costs that they'll have throughout the project. So we are a loan to cost lender. Much like most other private credit facilities, the way that we calculate costs is the current cost of the project, either the purchase price, what they paid for it within the last 12 months, or what it's worth today if they've owned it for 12 months or longer, plus the construction budget. I'll say that again to make it clear. So we base current cost, off of what they're buying the property for, what they paid for the property if they've owned it for less than a year, or what its current value is if they've owned it for 1 year or longer. And then, of course, the construction budget on top of that. You add those two numbers together, and that gives you your total cost. We've got 3 different options that we we offer to most ground up construction projects. So the highest leverage option that we've got, 90% loan to cost, starts at about 10.5%, 1.25 points on origination. Some key things to remember if you're targeting the 90% loan to cost bucket, and that's going to be this is not a market standard. It's about 5% above the market, and the capital that extends this credit is typically looking for a couple of things. They want the project to be an infill location, so no rural. We want it to be in a primary market, really no secondary or tertiary markets. Suburban markets are okay as long as they're surrounding, major metro areas. And then they want the total loan amount to be, less than $750. We can get into the why in the Q&A section, but total loan amount max is going to be $750K. This is really for your spec builders that are building spec homes in that, $350 to $750K exit price point, where there's a plethora of buyers that can qualify for FHA or conventional financing at typical buyer rates. That's what these loans are really designed to accommodate for your spec builders. Tract homes, or if they're buying a piece of land that's close to other suburban infill builds, and they're developing 5 or 10 spec builds at a time. Our standard construction LTC is going to be 85%. This one's a little bit less on rate and fee. We're at a 10.25, and then 1 point for a well-qualified borrower. And these are going to be up to $2 million. We can kind of stretch that to $2.5 million, just depending upon the location. If it's in a higher cost area, and we are looking for the same typical amount of experience. We can do first timers, really not at 85% though. They're typically coming in a little bit lower, but this is for your folks that have some ground up construction experience, or really heavy flipping experience with maybe remodels and additions that we can kind of parlay into a higher leverage point for ground up construction. And then to get the lowest rate, which is really good today, 9.99% and a 3/4 point on origination. You're looking at an 80 loan to cost loan. This really works for folks that have already bought the lot cash. Maybe they can leverage the value in the lot. They don't need the full 100 or 90 or 85% to fully fund their build. They would enjoy a nice, reduced rate and reduced origination fee from us at Central Lending. Again, we go up to $2 million. 12 or 18 months is preferred. If it's a really simple build, modular or mobile home, we can certainly look at a 6-month term, although most of these are landing at 12 to 18 months. And we look at anything 1 to 10 unit residential, and we're looking at 5 acres or less as far as lot size. If they're building and they're developing a larger, tract of homes, we can always take a look at a larger than 5 acres. But typically we want to see it at less than 5 acres if they're developing a single family or a single parcel build. So if they're putting 10 units on a 20-acre tract, that's definitely something that we'd have to get an exception on. We can do it, but it's a little bit different of a property. So it would have a little bit of lower reduction or lower leverage, excuse me. Moving on, just talking about a couple of really simple case studies here. This is one that came in right at 85 loan to cost. This is here in my home market of Austin, Texas. The borrower picked it up for $339,950. We had a total build budget of $905,222. ARV came in really strong on this one at 1.8. We extended them a full 85% loan to cost budget. This was actually done for a first-time builder that did not have any ground up on title or experience on title, but they had significant flips as well as significant remodel additions. So we went ahead and extended them 85% here in Central Austin. So that's a recent case study that was done, and they're currently building that one today. Moving on to qualifications. Qualifications are essentially who we lend to. We are a business purpose lender, so we really like there to be a business entity in place. An LLC, LLP, a limited partnership, or a S corp of some sort is what we want to see on title when we close. Your typical docs are required for any entity. Articles, EIN proof, those types of things, operating agreement or bylaws if it's a corp. We do check background. That is something that we take pretty seriously, although we do take exceptions on some issues. Some things we don't take exception to at all. Any sort of history of financial crimes, if there's any sort of fraud, wire fraud being a big one, mortgage fraud being a big one, regardless of how long ago, regardless of how reformed they are, it's probably a pass for us. But ultimately, we will take a look at every background, and every background does get reviewed directly by our CEO. So every shot, every deal has a shot at getting approved. Just depends on the circumstances. Felony convictions. We definitely will fund a felony conviction if it's older than a certain number of years. And if it's not related to any sort of financial crime. So if you've got drug felonies from 10, 20, 30 years ago, probably not going to be a big deal, but we do want to make sure we understand the circumstances around those. So if you are talking to somebody with a previous felony conviction, we definitely want to get a really strong letter of explanation done so we can understand what happened in the past, why it happened, what the circumstances were, and why it won't happen again. Any other charges are, of course, reviewed on a case-by-case basis. We definitely look at credit. That's something that didn't make it onto this slide. But if your borrower or guarantor has a clean 36-month credit report, no liens, no collections, and maybe they just had some late pays during COVID or something like that, not going to be a big deal for us. No LOEs required if the 36-month history is clean and there's no collection accounts or open liens on their background. Liquidity. Liquidity is always a hot topic. We always want to make sure that the borrower is well capitalized via their budget as well as with their funds that they're going to have to bring to close. So our liquidity calculation is very simple. It's going to be down payment funds, closing costs, and then their reserves are calculated at 10% of the total loan amount at plus $10,000, right? They've got to have some lunch money while they're in the deal. We do definitely make exceptions on liquidity all the time. It is something that, we kind of pride ourselves on with being flexible. We're not going to blow a deal up over a borrower who's maybe short, 5 or 10 grand on a deal, especially if they have funds coming in from elsewhere and they're a well-qualified borrower. And repeat business always has a stronger potential for exception than a first timer with us. Again, we talked about property type previously. One thing that's interesting to note here is we do select commercial and mixed use on short-term bridge loans. Not really a ground up scenario there, but we can potentially look at that. especially with well-qualified borrowers in high-demand areas. We are in, I believe it's 43, maybe 38 states, something to that. But where we don't lend, down there in the bottom left, Arkansas, Arizona, California, Idaho, Minnesota, Nevada, North Dakota, Oregon, South Dakota, Utah, or Vermont. Those are the only states that we are currently not eligible to lend in. And we are working on bringing on additional states. We just have to have the market demand there. And then we do lend to foreign nationals. We consider them remote borrowers. Something really important to note about a remote borrower is we definitely want to understand who's managing their project, right? So if they're, snowbirds from Canada and they want to build some spec homes, or they do build spec homes down in South Florida, and they're not able to be here all the time. We want to know who the general contractor is, what their qualifications are, and how they're going to essentially manage that project, whether they're from Canada, Mexico, or overseas in Europe or Asia. We want to understand, what the who's in charge of running the boots on the ground operation for any foreign national borrowers. We treat them as a 660 FICO, which is nice because there's no required interest reserve that we require them to put down if they're above a 660. And that's only if no U.S. score is available. If they are a foreign national residing in the States, the only thing that we need to provide is documentation as to their status in the United States. So either the arrival departure record that shows the length of time that they're allowed to be here, or if they've got some sort of other work visa or work authorization card, or just some sort of documentation that proves that they are, not here undocumented. So that is what we require on foreign nationals. All right, so let's talk about credit and experience adjustments here. So this is a lot of information. If you can screen grab this is a really easy and good way to look at why something might be reduced as far as loan to cost goes, and why there might be a higher fee on something. If there is, typically a reduced loan to cost, you typically have a higher rate and fee as well. So keep that in mind. Although it doesn't look like there's any rate adjusters here, these are all just LTC and fee adjusters to origination. One really cool thing to think about when you are quoting a borrower, if you head over to our online Sizer, if you don't have a credential yet, you can sign yourself up. It's miloservicing.com. There is going to be a website here at the end of the presentation. You can click the link on that, and it'll take you over to it. Again, miloservicing.com. Set yourself up as a broker, and you get access to real-time pricing for any type of scenario. The one thing that the system is not quite smart enough yet to do is to figure out some of the deal-based adjustments. The ones that it's really going to struggle with are going to be the rural designation, partially rural, and then there are some metro areas that take an LTC hit. And those areas are Detroit, Chicago, Baltimore, and Philadelphia. So how do you determine if something's rural? How do you determine if something's partially rural? We have a funny thing that our boss likes to call the trick or treat test. If they can go trick or treating, there's a good chance that it's not rural, right? They're not having to cross cornfields. They're not having to walk a mile to go ring a doorbell and say trick or treat. Probably maybe not fully rural. We might consider that more partially rural for some of those more remote neighborhoods. And then, of course, however close you are to a major metropolitan area or a major metropolitan statistical area, those are really important factors as well. So, if they're 20, 30 minutes outside of a major area, maybe they are surrounded by acreage, but maybe they can, commute into a major city and they're 20, 25, 30 minutes away on that commute. You'd probably take a partially rural designation on that as opposed to going fully rural. Detroit, Chicago, Baltimore, and Philadelphia, those are pretty self-explanatory. I do want to clarify, though, that the way that we do this is if it has a Detroit address, if it has a Chicago address, if it has a Baltimore address, if it has a Philadelphia address. If they're in suburban areas surrounding these areas, they typically don't take that hit. So if they've got a different municipality, that's an example that comes to mind is if they're in, maybe in Naperville, Chicago, you're not going to take a 5% hit for that, even though it's considered part of the greater Chicago area. You're still not going to take a hit for it. We're talking Chicago USPS addresses. Everything else on this is pretty self-explanatory. We consider one thing for experience we consider is we have a 24-month look back as opposed to a 36. While it is important to know the entire gauge of their experience, because 2 years is not that recent. You're talking about 2024 or after at this point, or it's not that long of a time frame. Excuse me. We will consider experience if it's older than 24 months. Especially if we're considering things like making an exception. Every one of our loan officers is empowered to offer an exception on any deal. It just has to make sense, has to be for the right borrower, and we want to make sure we understand why the exception is being granted. So don't feel like if you've got a borrower that did 10 houses 3 years ago and they've been living off that money for the last 3 years that they won't get a really, really good leverage with us, because they will. We can make a case for that borrower that's got good experience that might be just a little bit aged. And then as you can see, we have no credit minimum. Moving over to the credit box here. If they've got less than a 600 credit score, we will still do it. There is a very significant LTC hit and a very significant fee increase. However, it is still very possible to get a deal done if they don't have, if they've got credit below the 600 threshold. Ideally, we want to see 700 plus borrowers. We want to see 3 experience, and we want to be in major areas. That's really important for us to go ahead and continue to move forward with your loan. That's going to get the highest leverage at the best rate and the lowest fee possible. You guys have any questions? Again, we have a Q&A. Just want to pause for a second and say that we'll answer any questions you have about these adjustments, how we calculate them, why they exist, and what they mean essentially for any deal that you send to us here at Central. And then just going kind of to a big overview with why people choose to fund loans at Central Lending. We've done, over $390 million in total origination since inception. We currently have $117 million plus in servicing. So that's active loans that our lending partners have sent to us that we've closed for you guys. So thank you if you've closed a loan with us in the past. We service, I forget the number of loans, but it's a lot. I think it's over 500 at this point. So those are loans that have closed, with relatively within the last 18 months or so. We've done over 1,900 loans, total since inception. So we've seen a lot of deal flow. And then we have a pretty strong Google rating at 4.6 stars. We definitely want to be your first thought when you think of fix and flip, ground up construction, DSCR, and then bridge loans. And we are willing to look at out of the box scenarios. So please send those to your AE. And if you don't have an AE yet, you'll have my contact information here at the end of this. And you can send them to me and I'll get you assigned to a responsive person. We definitely want to be considered the fast, reliable funding partner built on transparency, driven by service, and powered by the belief that real estate investing should be accessible to anyone. That's why you'll see, a loan offer for a sub 600 credit score or for a no experience borrower. We're willing to do those. We want to see those submissions. And we talked about our products already: investor rehab, fix and flip, bridge loans, ground up construction, and then DSCR and rental. All right, so I am going to open up the floor for the Q&A, and we will get that started here momentarily. So Apparently, there is an area to submit your questions on the slide. We'll give it a few minutes to see, or excuse me, on the website. So we'll give it a few minutes to see if any questions trickle in. If not, we had some questions that were pre-sent in that we can answer, but we'll give it a few minutes to answer your questions if they come in more before discussing those. So please put your questions in. We're happy to answer them. All right, so it looks like we've got a couple out there. All right, so the first question is how does central lending treat mid-construction refis? These are tough. These are not easy files. If you've ever worked on one, you know that they get scrutinized really, really, with a fine-tooth comb is what's coming to mind. So when we look at a mid-construction refi, we really want to know essentially the backstory of the deal. We want to know what happened with the first lender, what happened with their funding. Did the borrower run out of money? Did they make their payments on time? Did they have a struggle getting permits or planning done? Or did they really just sit on their hands and not do the project? And now they're, a month from maturity and they're needing to struggle with refinancing they're needing to find refinancing because their current lender doesn't want to extend them or refinance them for whatever reason. So we are looking at it from a true cost basis. And what that means is we want to know what they paid for the property, how much have they spent on the property to date. We still look at the current value. We want to know what it's worth today. We want to know what they've got to finish it, how much construction is left, and then of course what it's worth when it's done. There's an eyeball test, right? So if they're telling us they spent $200,000 in framing on a 2,000 square foot house, that is obviously is going to be an issue. We want to understand, where they spent their money, why they did it the way they did it, and what the story is with why they're needing to refinance. Why didn't they complete their side of the deal with their current lender? It doesn't mean that it's a dead deal automatically. It just means that it's going to have a little bit more of a check and balance before it goes to funding. We will do them. We have done them. I've done them personally. And we will absolutely consider anything that is mid-construction for a strong borrower. Got one in the chat right now. It says, what valuation method does central lending use for ground up construction? We are going to look at simply an appraisal. That's what most of the capital providers in this space are going to want to see. We do consider an appraisal as the kind of the firm valuation, whether that be a purchase or a rehab. We definitely want to see a good valuation with that. We may get a secondary valuation. We might do our own underwriting, but for the most part, appraisals are what we are going to rely on to get a ground up construction loan funded. A couple other ones came in. It looks like, are second liens or seller financing allowed? Yes, as a matter of fact, we just closed one, which the borrower only had to bring 5% of the total cost down. So we did effectively a 85% loan to cost ground up construction loan. The seller held the 10% second, and the borrower only had to bring 5% down. Of course, again, like anything else, the story is important. It was a strong borrower. It was in a great area of Florida that we know really, really well. And we know the seller, we know the borrower, and it was their first loan with us, but we've seen their activity in that market, and we felt comfortable extending that amount of credit to them. So we do allow seconds, we do allow seller financing if it makes sense, but the borrower does have to have a minimum of 5% of their own cash in the deal. I've got another one here. Are feasibility studies required? A full feasibility study is not required. However, we do scrutinize the budget. We make sure that it's in line with market costs. We make sure that there is, a fair budget in place, whether it be too small or too large. We want to make sure that the borrower is well capitalized. So we will look at the budget and determine if the line item is sufficient for the line item. And we'll also determine if it is overfunded for the line item. Again, going back to the $200,000 in framing for a 1,000 square foot house. That just doesn't make sense. So we will have a detailed discussion with you guys about any budget that you submit. We want to make sure it makes sense for the borrower. All right, a couple more. Are plans and permits required to close? On purchases, plans, of course, we want to have an idea of what they're building. Otherwise, we can't really get a value. So some sort of plans are helpful. They don't have to be exactly what the borrower is going to build, but we want to get a very good idea of what the borrower is going to build so we can get an after repair value. And then permits are not required. As we all know, you can't pull a permit on something you don't own yet. If the borrower is buying a property that is already planned and permitted, that's helpful, but it is not required. On refinances, the general rule of thumb is you've had time to go get a plan set and you've had time to go pull a permit. So ideally, we would want to see plans and permits in place on a refinance. This is a property that the borrower already owns. All that to say, it is not a hard and fast rule. We have closed loans, especially refinances, without permits in place, but there has to be a good reason behind it, and we need to understand the why. And it looks like, I think that's it. I think that's it for questions. We'll give it one more second for questions. Anybody have a burning desire to share something, question that they have answer or that they want the answer to with anything related to private lending or ground up construction? All right, I don't see any questions. So wanted to thank everybody for their time joining us today. Thursday afternoons are usually the rush to get everything done for Friday, so we appreciate you making the effort to join us. We really look forward to submissions. I want to make a quick call out to the appointment set or deal submission, so you can QR code or you can just open the QR codes on the screen here to either schedule a call with me or submit a deal directly. And then you've got my phone number there at the bottom. We are really looking forward to continuing to grow our ground up construction fundings. We want to see your submissions. If you think it's an off the wall deal, just send it. We pride ourselves in getting to you very quickly to let you know if it's something we can do or can't do. We want to see them, no matter how crazy you think it is, if it's a, 500 credit score borrower who's never built a house before, but they got a crazy good deal, there's a really good chance that we can get something like that done. Hopefully you're sending us your spec builders that have good credit and they've done, 10 houses in the last 2 years, and we can give them a really great rate with 90% loan to cost financing. But if that's not the case, and that's not what you're seeing in today's market, don't just say no to something if it's not something that you are comfortable with. Send it to us. Let us make the judgment call, and we'll let you know if we can fund it or not. Thank you again. We appreciate your time and effort in joining us this afternoon, and we look forward to seeing those submissions. Thanks, guys.